when to sell a stock. The 6 red flags Wall Street never tells you. Most investors are obsessed with one thing: how to buy a stock. But here's the uncomfortable truth that almost no one talks about. The real money, the life-changing money, comes from knowing when to sell. And yet, most Americans never learn this skill. Here's a number that should make you pause. The average U.S. investor underperforms the S&P 500 by 6-7% every single year. But not because they're bad stock pickers. It's because they sell at the wrong time, for the wrong reasons, with the wrong information. Side-by-side compounding chart, $500,000 compounded at 8% versus $500,000 at 2%. Caption: the cost of poor sell decisions, $1, 3M lost over 20 years. Think about that. A 6% performance gap over 20 years doesn't just cost you some returns. It can cost you an entire retirement, the difference between living with comfort and running out of money at 72. Pause for a moment. Imagine your future self sitting at the kitchen table, opening your brokerage account, and realizing that half of your losses didn't come from market crashes, inflation, or bad luck. They came from holding onto a bad stock far longer than you should have. Charlie Munger once said a line that should be printed on every brokerage app in America: if you don't know when to sell, you will never know how to invest. People remember Munger for his patience, for holding great companies forever. But here's what most people forget. Munger sold ruthlessly when the facts changed. He didn't marry his stocks. He didn't cling to hope. He didn't negotiate with reality. And today, most investors are sitting on ticking time bombs without knowing it. Businesses showing warning signs that professionals can spot months, even years, before the collapse. Because here's the truth: Wall Street will never tell you. Stock charts don't predict the fall. Headlines don't predict the fall. Price targets don't predict the fall. But the business always tells you first. You just need to know where to look. In this video, you're going to learn the 6 red flags that reveal, with surprising accuracy, when it's time to sell a stock. These are the signals analysts see, but retail investors miss. The signs that start small but end in disaster. The clues inside a company's fundamentals that quietly warn you it's time to get out. By the end of this video, you'll have a simple, repeatable, unemotional sell framework, one you can use to protect your 401, your IRA, and your future. Let's get started. Why does learning when to sell matter right now more than ever before in modern American investing? Because today's investor isn't facing the same market your parents or grandparents faced. You're navigating a financial landscape that's more fragile, more deceptive, and more volatile than at any time in the last 40 years. We're living in a world where inflation eats away at your savings every month. Interest rates are the highest in over a decade. Corporate debt is exploding. The S&P 500 is propped up by a tiny handful of mega-cap companies. And your retirement dollars no longer stretch the way they used to. $1 in 2000 equals $1.70 needed today to buy the same goods. For Americans, in their 40 seconds, 50 seconds, and 60 seconds, this is not an abstract problem. It's real. It's monthly. It's in your 401, your IRA, your checking account, and your grocery cart. But here's the part no one tells you. In this environment, holding the wrong stock too long is far more dangerous than it used to be. And this is where Charlie Munger's wisdom becomes absolutely essential. Most people think of Munger as the guy who held great companies forever: Coca-Cola, Costco, BYD. But the deeper truth is this: Munger didn't hold great companies forever because he was stubborn. He held them because the businesses stayed great. The moment the underlying economics changed, he acted. Munger once said, "The trick is to get out before the decline is obvious." That single sentence separates average investors from disciplined wealth builders. Today's market punishes hesitation. It punishes emotional decision-making. It punishes the mindset of, it'll bounce back eventually. Many companies never bounce back. Ask anyone who held GE from the peak. Ask anyone who held AT&T for 10 years. Ask anyone who believed in Peloton at $160. Ask anyone stuck with Bed Bath & Beyond, Blockbuster, Sears, or BlackBerry. The red flags were visible years before the collapse, but retail investors didn't know how to recognize them. And this is the core problem. Most people don't have a sell strategy. They only have a buy strategy. They know how to enter, but not how to exit. And without an exit plan, even the smartest investors eventually sabotage their own returns. So here's the transition as we enter the core of this video. Most investors think the right time to sell is when the price drops. But that's wrong. The right time to sell is when the business changes. And the first and most important sign of trouble starts with the company's top line. Let's move to red flag has shown. The very first red flag, the one that professionals spot instantly and retail investors ignore for months, is this. Red flag has shown revenue growth slows for 2-3 consecutive quarters, not earnings, not net income, not P/E ratios or price movements. Revenue, because revenue is the raw truth of a business. Revenue tells you whether customers still want what the company is selling. Revenue shows whether demand is rising or fading. Revenue is the indicator that CEOs and CFOs cannot hide for long. Charlie Munger once said, if the business doesn't get better, you should assume it's getting worse. And the first place worse shows up is the top line. Let me show you how dangerous this can be with a real-world scenario you might recognize. The slow revenue fade that destroys portfolios. Imagine you bought a promising tech stock for your retirement account. You invested $25,000, feeling confident, strong brand, big market, plenty of analyst hype. Year begins. Quarter 1, revenue plus 14%. Quarter 2, revenue plus 8%. Quarter 3, revenue plus 3%. Quarter 4, revenue 0%. Trend line flattening over 4 quarters. Green turning yellow, then red. What does Wall Street say? It's temporary. It's supply chain issues. It's seasonality. It's just macro headwinds. What is actually happening? Customer demand is slowing. Competition is rising. The product is losing momentum. The business is weakening at its core. But most retail investors ignore this. They're emotionally attached. They're hopeful. They think the dip is a buying opportunity. Then the next year hits. Quarter 1, 4% revenue. Quarter 2, 7% revenue. Suddenly the stock drops 35-50%. Your $25,000 is now $14,000 and the pain becomes real. This pattern has happened again and again. Peloton, Snap, Intel, old media companies, retailers losing ground to Amazon. Every collapse began with slowing revenue. Why this red flag matters so much? Because companies don't cut employees /R&D or take on risky debt when revenue is growing. They only do that when revenue is stagnating. Revenue slowdown, margin compression, debt buildup, desperation, stock collapse. It all starts right here. And Munger's philosophy is brutally simple. All investing is laying out money now to get more money later. Without growth, you lose the later. Mini summary. Revenue is the first and clearest sign a business is weakening. 2 declining quarters equals yellow light. 3 declining quarters equals red light. Flat revenue is not safety, it's a warning. If revenue slows, start preparing your exit plan. Next, we move to red flag #2, a silent killer inside nearly every long-term decline. Shrinking profit margins. If revenue is the body of a business, then margins are the heartbeat. And when the heartbeat weakens, the entire organism is in trouble. Red flag #2, profit margins shrink for 2 or more consecutive quarters. This is one of the most reliable predictors of long-term decline. Yet most retail investors never look at margins at all. They look at stock price, they look at headlines, they look at analyst ratings, but professional investors, they watch margins like a hawk, because margins tell you something that earnings and revenue cannot. Is the company losing pricing power? Charlie Munger once said, "The great businesses are the ones that can raise prices without losing customers. Margin compression tells you the exact opposite is happening. Let's break this down. What causes margins to shrink? Rising competition, higher cost of goods, weakening demand, a fading brand, outdated products, poor management execution, a shrinking moat. All of these are dangerous because they usually don't fix themselves. When margins fall, companies get desperate. They cut R&D. They shrink marketing. They delay new product launches. They lay off employees. They take on debt to maintain appearances. Every one of these reactions weakens the business even more. It becomes a downward spiral. Case example, a high-margin business in slow collapse. Imagine a beloved consumer brand with strong margins, 28% net margin, extremely healthy. But then the red flags start. Quarter one, 26%. Quarter two, 24%. Quarter three, 22%. Quarter four, 19%. Bar chart with shrinking red arrows. On the surface, this doesn't look catastrophic. The company is still profitable. But professionals know this truth. Margins rarely decline by accident. They decline because the business is losing power. Competitors are undercutting prices. Customers are switching. Supply chains are tightening. The moat is shrinking. The stock doesn't crash right away. That's the trap. Instead, it bleeds slowly for years. Think of companies like AT&T, Intel, many old retail chains, once great businesses whose margins eroded long before their stock charts showed the damage. Why margin compression is a massive sell signal? Because margins are the purest measurement of business strength. You can manipulate earnings, you can manipulate guidance, you can manipulate buybacks, but you cannot fake shrinking margins. When a company loses pricing power, it loses its moat. And when it loses its moat, it loses its future. Charlie Munger warned, there are only two ways to succeed in business: raise prices or lower costs. If you can't do either, your business is in trouble. Margin compression tells you the business can no longer do either. Mini summary. The sector's stuff great. Shrinking margins equals shrinking moat. 2 quarters of compression equals warning. 3 quarters equals serious danger. Falling margins always appear before falling stock prices. Margin compression is a red flag that requires immediate attention. Next, we move to red flag #3, one that Munger personally feared more than almost anything: rising debt combined with slowing growth. If there is one red flag Charlie Munger disliked more than almost anything else, it's debt specifically. Debt rising while the business stops growing. Munger once warned, if you're not confused by leverage, you don't understand it. He didn't say that to be clever. He said it because leverage destroys businesses far faster than investors realize, especially in a high interest rate environment like today. And that brings us to red flag #3. Debt is rising while revenue or free cash flow is flat or declining. This is one of the most dangerous combinations in all of investing. Here's why. When a company borrows to grow, build factories, invest in R&D, expand internationally, that can be fine. But when a company borrows to survive, to pay dividends, fund buybacks, or simply keep the lights on, that's a flashing, blaring warning sign. Let's make this real. The interest expense, death spiral. Imagine a company carrying $2 billion in long-term debt. For years, interest rates were low. At 3%, their yearly interest payment was just $60 million, manageable. But today's world is different. Interest rates rise. Refinancing becomes painful. Suddenly that 3% becomes 7%. Now interest costs jump to $140 million per year. Interest expense rising from $60M, $100, and $40M. That's an extra $80 million taken out of the business annually. If revenue is flat, if margins are shrinking, if cash flow is weakening, where does that extra $80 million come from? It comes from cutting employees, cutting innovation, cutting marketing, cutting dividends, selling assets, slowing product development. In other words, the company starts eating its own future just to survive today. This is exactly how iconic companies collapse slowly over time. Think about General Electric, Bed Bath & Beyond, AMC before the meme stock era. Telecom giants overloaded with debt. The story is always the same. High debt plus declining growth equals long-term disaster. Another hidden danger: debt-fueled buybacks. When a company uses debt to buy back shares, it looks good on paper. Earnings per share go up. Wall Street cheers. Retail investors get excited, but beneath the surface, the business is taking on long-term risk to create short-term stock price sugar highs. Charlie Munger hated this behavior. He believed companies should be deleveraging, not borrowing money to manipulate short-term numbers. He once said, "There's no company so good it can't be destroyed by bad debt." Mini summary: rising debt plus slowing revenue equals one of the strongest sell signals in investing. Interest rates matter. Refinancing can crush weak companies. Debt-fueled buybacks are a giant red flag. If debt rises while the business weakens, sell. Because debt doesn't kill companies all at once. It kills them slowly, quietly, and then suddenly. Next, we move to red flag #4, one of the most overlooked signs, and one that almost always appears before a stock begins its long decline. When management changes the story, there's a red flag that doesn't show up on financial statements, charts, or ratios, but it is one of the clearest signs a company is entering decline. Red flag #4, management quietly changes the story. Charlie Munger believed deeply in the power of transparency and consistency. He once said, "If you don't trust the management, you shouldn't own the business." And when management begins shifting narratives every year, every quarter, that trust should disappear immediately. What does changing the story look like? It starts subtly. Year 1, we're focused on innovation and market expansion. Year 2, we're emphasizing operational efficiency. Year 3, we're navigating near-term macro challenges. Year 4, we're restructuring for long-term success. If you line these statements up, they sound harmless, but together they reveal a company that is no longer in control of its destiny. Companies with strong fundamentals don't need to reinvent their story every year, because good businesses remain good regardless of headlines or market cycles. When management changes the story, it's usually because the underlying business is deteriorating and they're trying to buy time. Here are the biggest warning signs to watch for. Blaming macro conditions every quarter. Great companies outperform even in tough environments. When a CEO blames the economy over and over, it means they've run out of answers. 2, talking about buybacks instead of growth. When a company shifts from innovation to buybacks, it's a red flag. Buybacks often hide slowing demand. 4, avoiding direct questions on earnings calls. If management dodges basic questions about margins, demand, costs, or competition, something is wrong. 5, overpromising and underdelivering. If management keeps saying the second half will be stronger and it never is, that's a sell signal. Charlie Munger despised this behavior. He admired managers who spoke plainly, admitted mistakes, and stayed consistent. He once said, "If you don't see integrity in the management, don't walk, run." A real example: the slow narrative drift. Consider a once-loved retail company. In 2018, leadership talked about growth and store expansion. In 2019, they talked about digital transformation. In 2020, they talked about survival during the pandemic. In 2021, they talked about restructuring. In 2022, they talked about exploring strategic alternatives. Translation: decline, desperation, collapse. The story changed because the business was failing, and investors who paid attention to the narrative shift, not the stock price, saved themselves years of losses. Mini summary: strong businesses have consistent stories. Weak businesses reinvent their story every year. If management shifts from growth to excuses, exit. Integrity plus consistency equals Munger's Hayshown filter for ownership. Next, we move to red flag #5, one of the most predictive and least manipulated indicators. Declining free cash flow. If revenue is the body and margins are the heartbeat, then free cash flow is the oxygen that keeps a company alive. And when oxygen begins to thin, everything else collapses soon after. Red flag hash 5. Free cash flow declines, especially while earnings look stable. This is one of the most dangerous disconnects in investing. A company can look profitable on paper while its cash flow is quietly drying up underneath. Charlie Munger put it simply. At the end of the day, it's the cash that counts. Free cash flow is the money a company actually has left after running its business and maintaining its assets. It pays for dividends, buybacks, debt repayment, R&D, acquisitions, expansion. Without free cash flow, a company cannot grow and eventually cannot survive. Why this red flag is so powerful. Companies can manipulate earnings. They can adjust depreciation assumptions. They can change expense recognition, timing. They can play accounting games. But free cash flow, it's brutally honest. When free cash flow declines over 2-3 consecutive quarters, it means one of 3 things is happening and all 3 are bad. 1, the core business is weakening. Demand is dropping. Customers are spending less. Competition is rising. 2, costs are rising faster than revenue. This often confirms red flag hash 2. 3, management is overspending to hide deeper problems. Sometimes they pour money into growth initiatives that simply mask stagnation. The dividend mirage. This is a trap many retirees fall into. Imagine you own a stock that pays a safe 4% dividend. You're relying on it in retirement. It feels stable. But here's the truth hiding underneath. Dividend payout, $1 billion. Free cash flow, $800 million. The dividend isn't actually being funded by operations. It's being funded by debt, asset sales, or financial engineering. This is the exact setup that leads to catastrophic outcomes. Dividend cut, investor panic, 20-50% stock price drop, emotional selling at the bottom. Think AT&T, think Intel during its long decline, think dozens of high-yield retirement stocks that collapsed over the last decade. The dividend isn't the red flag. The free cash flow trend is dividend is greater than free cash flow equals major risk. What Munger would say, Charlie Munger never chased dividends. He chased durability, because durability creates decades of compounding, and durability always shows up in free cash flow. He said, you can't get rich by ignoring reality, especially the reality printed in cash flow statements. His mini summary, free cash flow is the real profit of a business. If free cash flow declines while earnings stay flat, something is wrong. Dividend safety depends entirely on cash flow, not yield. Declining free cash flow almost always appears before long-term stock declines. Next, we move into the final and most important red flag of all, red flag hash 6, the erosion of the company's competitive moat. We've reached the 6th and final red flag, the one Charlie Munger cared about more than almost anything else. Red flag hash 6, the company's competitive moat is shrinking. Every great business has a moat. A moat is what keeps competitors from stealing customers. Strong brand, patented technology, network effects, switching costs, low-cost advantages, superior distribution, massive scale. A moat protects profits. A moat protects margins. A moat protects your investment. And when the moat shrinks, everything else follows. Charlie Munger said, the whole trick is to get a business with a durable competitive advantage. Not temporary, not fashionable, durable. When a moat erodes, revenue slows, margins compress, debt rises, cash flow falls, management changes the story. All the other red flags you've learned, they often start right here. How to detect a shrinking moat. Most investors only notice a moat is gone after the stock crashes, but the early signs appear years in advance. Here are the 5 most reliable indicators. 1, competitors start copying key products. When alternatives appear cheaper, faster, or more convenient, the moat is thinning. Think of how Android phones close the gap on Apple. Though Apple rebuilt its moat with ecosystem lock-in. 2. Customers are switching more easily. If switching requires just a few clicks or a simple app download, the moat isn't strong. 3. The company lowers prices to keep customers. Lower prices equals weaker pricing power equals weakening moat. 4. Industry shifts and the company fails to adapt. BlackBerry didn't adapt to touchscreens. Kodak ignored digital photography. Intel ignored TSMC's manufacturing superiority. A moat is not permanent. It must be defended. 5. Reviews and customer sentiment start falling. Bad product reviews, declining satisfaction, more returns. This is the early warning system of moat erosion. A real example, moat erosion in slow motion. Think of a company like Intel, once unmatched, dominant market share, superior technology, a fortress-level moat. But competitors improved faster. Customers switched. Foundries became more advanced. The moat, which once felt indestructible, shrank quietly, and the stock followed. Moat erosion always shows up in the fundamentals, long before it shows up in the stock chart. Charlie Munger warned us, over the long term, it's hard for a company with a weak moat to compete. The market eventually agrees brutally. Mini summary, a shrinking moat is the ultimate sell signal. All other red flags often originate from moat erosion. Competitors catching up equals danger. If a company must discount, innovate reactively, or chase trends, the moat is weakening. When the moat disappears, your money should too. How to turn 6 red flags into a real sell system. You now understand the 6 major red flags: slowing revenue, shrinking margins, rising debt, a shifting narrative, declining free cash flow, a weakening moat. But information only becomes power when you turn it into a system, a step-by-step process you can follow consistently, without emotion, without guesswork, and without relying on analysts who don't know your retirement goals. So in this section, we're going to convert everything into a simple, repeatable sell framework, one you can run on your portfolio every quarter. This eliminates fear. This eliminates hesitation. This eliminates I'll wait and see, because waiting is where portfolios go to die. Is step 1, run the red flag audit every 90 days. Quarterly 6 flag audit checklist. Every 3 months, for each stock you own, ask, is revenue slowing? Are margins compressing? Is debt rising faster than revenue? Has management changed the story? Is free cash flow declining? Is the moat weakening? Here is the rule professionals use. 0-1 red flags. Hold confidently. 2 red flags. Reevaluate position size. 3 red flags. Begin exit planning. 4+ red flags. Sell immediately. This isn't emotional. It's mechanical. It's rational. It's how disciplined investors survive multiple market cycles. Charlie Munger said, you don't have to be brilliant, you just have to avoid the big mistakes. This framework helps you avoid the big mistakes. Well, step 2, write down your original thesis. If you bought a stock for its high growth and now the company has no growth, that stock no longer fits your thesis. If you bought for margin strength and margins are shrinking, your thesis is broken. If the facts change, I change. You must do the same. STE step 3. Create a predefined sell trigger. Investors lose money because they decide to sell after panic sets in. Professionals decide to sell before it happens. Examples of sell triggers. If revenue slows 3 quarters in a row, I reduce by 50%. If free cash flow declines 2 years straight, I exit fully. If debt rises faster than profit for 12 months, I sell. Document your triggers. Stick to them. Step 4, reallocate into stronger companies. When you sell a weak company, don't just sit in regret. Move that capital toward businesses with expanding margins, strong free cash flow, honest, consistent management, durable, widening moats. Compounding accelerates when money moves towards strength. Step 5, protect emotional investors. Most people sabotage their portfolio, not because of bad stocks, but because of bad habits. So set these rules. Don't hold losers because of hope. Don't marry stocks. Don't rely on price predictions. Follow your system, not your emotions. The big money is in the discipline. This is the discipline he meant, is mini summary. Run a quarterly audit. Follow a rules-based sell system. Exit at 3 plus red flags. Reinvest into stronger businesses. Protect compounding at all costs. Tying everything together and why this matters for your life. When you step back and look at everything we covered, the revenue slowdown, the shrinking margins, the rising debt, the shifting narrative, the declining cash flow, the collapsing moat, you start to see something deeper. Selling a stock isn't just a financial decision. It's a life decision, because your investments are not just tickers. They're not just charts or ratios or quarterly reports. They're your future. They're your dignity. They're your independence. They're the difference between working at 72 because you have to, and retiring at 62 because you planned wisely. And the biggest enemy of your financial future isn't volatility. It isn't recessions. It isn't even bear markets. It's hesitation. The hesitation to act, the hesitation to sell, the hesitation to protect yourself. Charlie Munger once said, "The first rule of compounding is to never interrupt it unnecessarily. But there's a second rule that is just as important. Don't let weak businesses interrupt your compounding either." Selling is how you protect compounding. Selling is how you defend your retirement. Selling is how you avoid the catastrophic losses that take decades to recover from. Here's the truth. You don't need 40 great investments in your life. You need a handful, maybe 5, maybe 10 at most. But you do need to avoid the wealth-destroying losers that drain your portfolio year after year while Wall Street tells you to think long-term. Long-term only works with great companies, not declining ones, not leveraged ones, not ones with shrinking moats, and you now hold the framework to see these red flags long before the damage is permanent. This channel is here to help Americans invest with clarity, discipline, and confidence without the noise, hype, or speculation. We make videos for people who care about their retirement, people who want to build wealth slowly, safely, and intelligently, people who understand that discipline beats excitement every single time. Before you go, answer this in the comments. Which of the 6 red flags have you ignored before, and what did it cost you? Your story might help another investor avoid a painful loss. And remember, you don't have to be perfect. You just have to be disciplined. Your future self will thank you for it.